Great, and welcome everyone to this week's speaker series. I'm happy to be joined today with Alec Murray. Alec joining us from Amundi Pioneer. Alec, thank you for joining us this week.
Thank you for having me. It's a pleasure to be here.
Excellent. Alec, so you're associated with one of the oldest funds in the world, right? Your fund started in 1928. So that's quite a long time to be in business. Any kind of sort of thoughts or sentiments you'd like to share in that regard?
Absolutely. You're exactly right. So the U.S. version of U.S. Pioneer Fund, called Pioneer Fund, dates back to 1928, and legendary investor Phil Carret, who started not only the fund but the firm, he managed the fund for 55 years. He was actually a mentor of Warren Buffett's, who once said of Mr. Carret that he had the best long-term track record of anybody he knew. And in fact, since inception in 1928 through the end of last year, the US fund has outperformed the S&P 500 index, arguably the most competitive asset class in the world, by more than 2% a year net of fees. So in an environment where investors have increasingly have opted to go passive in US large cap, particularly US large cap blend, we believe this is a case study in the value of going active.
Okay, great. And we'll jump into the fund here in just a minute. But Alec, before we turn to the fund, let's talk about the macro environment. It's obviously been a very difficult year for investors. They've been hit on the bond side. That's been a bit of an anomaly. Volatility tends to be more associated with on the equity side, but even then, it's been a pretty volatile year. U.S. equity markets are down. Let's say the S&P's down 15, 16%. I have to see how it ends today, though. It's quite a tear today. NASDAQ breached bear market territory a while back. It got as low as almost 30%. Any sort of thoughts or broad overview as to how equity markets have done to start the year?
Sure. So we actually think this is a pivotal moment in U.S. equities. Actually, if you go back, there's been basically a 40-year run from an interest rate perspective. So interest rates peaked 40 years ago and have been going down more or less straight down ever since. And that's provided a huge tailwind for bonds, stocks to some extent. And in more recent years, as you know, it's provided a significant tailwind for hypergrowth stocks, those highly valued stocks that have either no earnings or very little earnings. Those stocks did very well in the last few years as interest rates reached historic lows. And the reason for that, obviously, is that the discount rate plummeted. And because those are long duration assets with a net present value calculation benefiting from a lower discount rate, those stocks did really well. But now the reverse has happened. Interest rates have started to rise, and we actually think inflation is going to be sustained at a higher than Fed target level for the foreseeable future, which means going forward, we think the types of equities that are going to do well are very different than the types of equities that have done well in the last 5 to 10 years.
Yeah, we actually agree with you. We think the bond bull market that you're talking about ended in March of 2020. So we also think we have as a firm view here that we're going to have higher highs and higher lows on rates going forward. We kind of share that view in terms of, and we've definitely seen the value space outperform tech and growth to start the year. Do you expect that to continue? Do you think tech will continue the same pace of underperformance? Do you think it'll, maybe reverse, or do you think what are your views on that breakdown by style, let's say for the rest of the year?
Sure. So just for context, we've made the call for the last year to 2 years that value would outperform growth. And we made that based on two assumptions or points. The first is that historically, if you look, value has outperformed growth in inflationary environments. And the reason for that, obviously, is that the value universe has greater exposure to commodities. So the energy index, the energy sector, for example, is about 8% of the Russell 1000 value index, only 0.5% of the Russell 1000 growth index. And so we thought with inflation at basically historic lows, it had nowhere to go but up. And as it went up, value began to outperform growth, and sure enough, it did. The second reason we made the case for value over growth was valuation. If you look over the last 25 years, value is traded at about a 6 multiple point discount to growth. Deservedly so. Slower growing, less profitability deserves to trade at a discount. but it got to a 12 to 13 multiple point discount, which was twice the normal average. So we made a strong case last year that value would begin outperforming growth. So far, it has this year. We think that will continue, however, much more selectively. So right now, we think value will outperform, but there are selective parts of value that are attractive and not attractive. And frankly, there are selective parts of growth now, given the valuation, the multiple compression, that are also attractive. So overall, value outperforms growth, but much more selective going forward than it has been so far this year.
Okay, so that's on a style basis. How about an overall absolute basis? How does a Mooney Pioneer? What's the outlook, let's say, for U.S. equity indices? Let's say over a 6 or 12-month window.
I mean, there's such the short answer to that question is we think there's probably about 5 to 10% more downside in equities from here. But that's kind of a base case assumption, which assumes that the economy slows without going into a recession, that profit margins come under some further pressure as a result of rising inflation. But, there's a range of possible outcomes there. So if supply chains ease, if the consumer holds up better than expected, there's certainly upside to our base case assumption there. Obviously, the reverse is also true. If we enter a recession, there's significant downside. So, we really don't spend a lot of time trying to actually forecast market returns. The bulk of our effort is spent on individual stocks, but our base case is probably 5 to 10% downside from here, but there's a range of outcomes around that.
Okay, and I'd like to remind everyone, if you do have questions for Alec, we're going to have a few minutes before the call ends at 4:30 to submit those questions or to ask him here live before we finish here or after we finish our discussion. So Alec, let's turn now to the fund and your investment process. As you know, U.S. equity markets are very efficient, lots of liquidity, lots of eyeballs. That's usually the academic case. It's usually like the academic case of why you should use passive investments over active investments, because any inefficiencies eventually get traded away, arbitraged away, and you're better off sort of being off in the index. What do you think what are some of the reasons you think that the fund has been able to outperform the benchmark since its inception in 1928, like you said, by 200 basis points?
Sure. So let me just set the stage a little bit. So before we get into the fund, we think this is the best time to be active in over 15 years. And the reason for that is because the last time active managers in the US significantly outperformed their benchmarks was after the dot-com bubble burst. And that was a period of time where the S&P 500 reached a record level of concentration. The top 5 stocks in the index at that time accounted for a little more than 18% of the index. At the end of last year, actually, there was a new record. The top 5 stocks were about 23 to 24% of the index. And what happened after the dot-com bubble burst in 2000, 2001, and 2002 is that more than 60% of active managers outperformed the S&P during those 3 years. And the reason is because active managers had much less exposure to those top 5 stocks. They were more diversified. Well, the same thing is happening now. So if you look actually across all 3 categories in the US, the Russell 1000 growth value S&P 500, the Morningstar large cap core averages are actually outperforming their respective benchmarks year to date because that concentration that exists right now in the S&P 500 is beginning to dissipate, and active managers have been able to invest elsewhere and pick up alpha along the way. So at a high level, we actually think this is a terrific time to be active managers. Now, your question wasn't that, it was why us specifically. And there are a couple of reasons. The first, as you pointed out, is we have a time-tested philosophy going back to 1928 that has resulted in outperformance over a very long period of time. We are only on our 5th lead manager in the fund's history, and there's actually a lot of continuity. So one of the PMs on the team right now was the former lead manager. He worked with the founder, Phil Correa. So that philosophy has been passed along from generation to generation. The second reason we think it's going to outperform is because this fund has done a great job mitigating downside risk. That's one of its primary objectives. And we think the market will remain volatile for the next year or so. And that ability to mitigate downside risk, we think will continue to result in alpha generation. And year to date, the fund has demonstrated that. And the third reason we think that the fund will outperform its peers is its incredible valuation discipline. So at purchase, each stock in the portfolio has to have 2-to-1 upside versus downside risk. And what that means is that this portfolio consists not of the hyper growth stocks that have done really well in the last couple of years, but have been demolished this year, and not of the low quality stocks that may be vulnerable to an inflationary environment. But what it consists of is those stocks in the middle, those reasonably priced stocks in growth and value that offer significant upside, but also mitigate downside risk in the process. So for those three reasons, we think this fund is a good active choice in this environment.
Okay. And Alec, so the skeptic would say, and I obviously have not seen the analysis of your fund specifically, but the skeptic would say, well, maybe it has to do because US equity markets in the 1930s, 40s were a lot less liquid, a lot less transparent, a lot less efficient, and that alpha was gained early on. Has that sort of market outperformance, let's say, survived into the present period, let's say over the last 20, 30 years?
It has, and actually, if you look over the last 5 years, even, for example, even on the A shares, which is fee heavy, the fund has actually been able to outperform the benchmark net of fees while mitigating downside risk. So yes, you're absolutely right. I mean, often when people talk about a long history, it's because, boy, back in 1929, 1930, it generated a stellar return and hasn't done much since, but that good start really carried it forward. That's not what we're talking about here. We're talking about a fund that has outperformed in the US since 1928, but if you look over the last 3 and 5 years, has done exceptionally well recently.
Okay, great. So now let's dive a little bit before we get to some questions from the field. Let's dive into your investment process. How do you, from the entire universe of S&P 500 names, that's your benchmark, right? The S&P 500.
Exactly.
How do you start narrowing down names? What's the investment? Talk us through the investment process of the fund.
Sure. So we're maniacally focused on identifying stocks that meet 3 specific criteria in addition to evaluation criteria. And those 3 criteria we call the 3 pillars of sustainability. So we're looking for companies that are competitively strong, financially sound, and socially responsible. So take a company like MasterCard. So MasterCard is the number 2 player in debit and Visa and debit and credit globally. So it has a very dominant position in its space. And of course, there's always competition, but very, very stable market share over time. That's the type of competitive advantage that we like to see. Hundreds of millions of people have MasterCard because millions of organizations accept it. Millions of organizations accept it because hundreds of millions of people have MasterCard. That's a moat that's very difficult to break. The second thing we look for is financial returns. So we look at free cash flow generation. Even during the pandemic, when travel evaporated and MasterCard was under a bit of pressure, it generated billions of dollars of free cash flow. The returns on capital are very high. So it's a profit generating machine. So that's the second thing we look for. And the third thing we look for is companies that are socially responsible. Now, socially responsible means a lot of things to a lot of people. We look at social responsibility through an economic lens. And from that perspective, MasterCard and Visa, for that matter, have done a great job with respect to cybersecurity, which is one of the big economic risks for both of those firms. So because they are socially responsible in that particular way, that supports our overall investment case for the stock. So those are the 3 criteria we look for. In terms of screening the universe, we have a quantitative screening process that we use to get down to a manageable number of stocks. And then we have a research team that does active, deep fundamental research on 150 to 200 stocks. And out of that research effort comes a portfolio typically of 40 to 50 stocks that actually make it into this portfolio.
Okay, great. And then so what's the average, let's say, holdings of the fund? How many stocks we're talking about, typical holding?
Typically 40 to 50. So right now, I think there are 47 stocks. And again, what we're offering here, to your point, it's a very competitive asset class. So if you and your investors are going to invest with us, we need to be focused enough to be different than the benchmark. Because if we're not different, we cannot perform. but we also want to be diversified enough to mitigate downside risk. And we found over time that range of 40 to 50 stocks is the right number.
Does the fund ever go outside the U.S. or into, let's say, small caps or other things beyond, what beyond would be typical for an S&P 500 name?
Very rarely. On occasion, it will dip down into mid cap, rarely into small cap. On occasion, it will buy a stock internationally if it happens to be sort of best in class, better than the US options. But we believe we're being paid by our investors to optimize within the US large cap universe. And so we do that with the thought that for your investors, you can asset allocate to international, to cash, to bonds as you see fit.
Okay, great. Okay, well, we started getting some questions here, Alex, so maybe we'll start going there. The first question is, in a fund that has almost 100 years and very long tenured teams, how do you break through sector biases and shift to those new sectors that will drive return?
So how do we? So that's a great point. So
I think the question kind of is sort of leaning like, how do you keep the team dynamic enough to be able to find new opportunities as they arise and not get sort of stale in their thinking or stale in their approach?
Yeah, so it's a wonderful question because you're right. As investors, it's easy to fall in love with sectors and with stocks. And really, one of the driving forces that answers that question is the valuation discipline. Because we have a team of analysts that comes up with a valuation on each and every stock. And it's not a single target price, it's 3 target price: a bull, a bear, and a base case. And by the way, they're scouring the universe. They're looking at new technologies. They're looking at companies applying new technologies and looking for changes in the competitive landscape one way or another. And based upon that, they're coming up with 3 target prices for every potential holding in this portfolio. And then based upon that, we come up with a risk reward analysis, 2-to-1 upside versus downside risk, and only stocks that meet that criteria fit into the particular portfolio. And what that valuation discipline forces is a recognition that some of the stocks in the portfolio may no longer be good fits. Their competitive position may have changed for the worse. They may not be delivering from a financial perspective. The product set that they have may not be appropriate going forward. All those things play into the analysis that we go through as part of the research process. So you're absolutely right. The biggest risk that any of us face as investors is to be stale in our thinking. And this valuation-driven approach, we think, is provocative in the sense is it forces that conversation and helps ensure that fresh thinking pervades the portfolio.
Okay. I have another question here asking, what was the year-to-date performance? I guess we could go as of the close of yesterday. It wouldn't be fair to ask you how the portfolio closed today with such a strong day in the markets.
Yeah, so through yesterday, I think the portfolio was outperforming by about 1% year to date. Let me just check here. So over the year-to-date period, it's down about, the A shares are down 15.47, the S&P 500 down 16.02. So about, a little less than 50 basis points outperformance year to date.
Right. Okay. And what's the sector breakdown more or less right now in terms of what different sectors are you invested in the portfolio?
So, there are 11 sectors in the S&P 500 index. We're invested in all basically but 2 of them. The 2 that we don't invest in right now are utilities and real estate. And those are really driven by those underweights are driven by 2 factors. One is they tend to act like bond proxies, meaning as interest rates go up, they tend to underperform. Now, recently they've been more defensive, so they've actually held up relatively well. But the second reason we're underweight utilities in particular is that if you look at utilities, they're trading at a premium to the S&P 500 on P multiple. Historically, they traded a discount. So investors have flocked to utilities for safety reasons. And in the process, we think overvalued them. So we have no exposure there for that particular reason. Where we do have significant exposure, we have an energy overweight. We also have a significant exposure to communication services on a stock-specific basis. We're finding some great opportunities there, particularly with the market correction in names like Alphabet and Electronic Arts.
Excellent. Great. One last question here, Alec. Any anecdotes from the history of the fund that are instructive to share?
Yeah. So Phil Carret was actually an aviator. He was a World War II aviator, and he was a former newspaper reporter. And then he decided that he was reporting on financial news that he could do a better job than others in actually managing money. So that's what led him to found Pioneer Investments and launch the fund. And frankly, it was a rough start. I mean, he launched in 1928. Obviously, it was a very difficult time for the economy and the markets, but he survived, persevered, managed to do well through that period of time, and developed the fund into something that's lasted for over 90 years and a firm that has stood the test of time. So it's a great long-term story, and we're honored to be part of the organization.
And one final question has come here. Are there particular traits or habits that you've maintained along, I guess, throughout the history of the fund?
Yeah. So basically, the original philosophy, if you go back and look at some of Phil Carret's writing, I mean, he was very much about investing in companies that were competitively strong, had very strong leadership positions. So if you look at that philosophy and being financially sound, and actually in the 1940s, this might be of interest to those of you who have some interest in ESG. He was, as far as we can tell, the first investor professionally to exclude alcohol, gaming, tobacco from the portfolio, not for any values reasons, but because he didn't think they were useful goods and services to society and wouldn't be good investments over time. So that's the history of the fund. It's a long history dating back to 1928, but it's also got a long history with respect to responsible investing.
Yes, we could maybe say the pioneer in ESG even without knowing it.
Exactly.
Great,
exactly.
Alec. Well, thank you so much for taking the time to be with us this week. We appreciate the conversation. We appreciate the time and insights. The Amundi Pioneer Fund since 1928. So that's a very long track record. So once again, Alec, thank you for joining us this week.
Thanks for your time. A pleasure. You take care.
Take care.
Bye-bye.
Goodbye, everyone. We'll see you next week.